The bond market is flashing warning signs. Mohamed El-Erian exposes what's really driving yields and Fed action. Credit worries, regional bank stress, and loose lending standards. El-Erian explains why Fed rate cuts may not fix what's coming next.
Concerns of the Fed.
Wait, you think there are like real things to be concerned about in those areas?
Look, I agree with what Jamie Dimon said, which is, cockroaches don't come in one and twos. And we are living through a period where credit has been incredibly loose. A lot of money has been thrown at borrowers, and you've had lax standards trying to get the money to work. So would I be surprised if we see more credit issues? No. Do I think it's systemic? Do I think it's something that really brings down the economy? No, I don't. But I do think you will hear the news of defaults, and certain players will be hit.
You raise an interesting point. It's like the two sides of the coin to very tight credit spreads. It's something everybody always cites as there's no problem, there's no seize up in the credit markets, but by nature, very tight credit spreads are going to lead to a lot of lending and huge demand because the environment is theoretically good to do so, but then maybe you get yourself into some of the issues that we're only now learning about.
You're absolutely right. The lower the level of the spreads, the more the curve flattens because people reach out for return, and they venture into areas they know less well, because at this point it's all about relative returns, and they forget about overall compensation for risk. I've seen it happen over and over again. So it doesn't surprise me, but I don't think it's systemic. But I do think it adds to the pressure on the Fed to cut. But it's not straightforward because, yes, they should be worried about employment, but inflation will go up in the months to come, and they don't know whether the employment side is a supply side issue or a demand side issue. If it's a supply side issue, they're going to be pushing on a string.
So Stephen Meyer, the newest Fed governor, he wants a half-point cut this month. Fed Governor Waller is more on a quarter point. Which way are they going to go?
I think they'll go quarter. They should have gone half last time.
Why shouldn't they go now a half?
Because I think now they have less clarity on what's happening in the economy. I think that's really important. Data for them is important. This is a data-dependent Fed. The fact that they're cutting when I suspect the CPI inflation is going to go above 3% is going to be already a question mark. But cut 50 when you haven't had the jobs data, that's going to be hard to explain.
What about the announcement on the balance sheet the other day that they're going to end the runoff or at least stop it for a while in the coming months? What do you think?
I think a little bit too early, but I understand why.
Why do you think that?
Because I do think you got to get back to an equilibrium level of the balance sheet. The balance sheet is still too big, but they have to. But I understand why. Is because they're worried about the labor side of the economy.
Well, do you think the economy's in a good place? I mean, you chair a corporate board that has Under Armour. That has a direct line into what the consumer is doing.
So on the surface, the economy is great. We had 3.8% growth in the second quarter, highest in 2 years. We're going to get over 3%. Inflation is contained. The Fed is easing. The stock market is booming. But gold is at record level. But the dollar is languishing.
You think that gold at record levels is more concerning than not?
Yes, it's a risk-off asset that has broken its correlations for good reason because of what's happening to the view of sovereign U.S.
So you think it is a debasement trade, so to speak, that's leading to gold?
Yeah. Look at the amount of inflows into our stock market from outside that are hedged, dollar hedged. So people love U.S. companies. They don't like the dollar. So they're hedging that. I think the other issue you've got to be concerned about is the decoupling. Low-income household from middle and upper-income household, that's a decoupling. The labor market from growth, that's a decoupling. So below the surface, there's a lot of question marks that suggest that we've got to be careful in the months ahead.